Joining us tonight, as always, is Scott Phillips. G'day, Scott. Hang on, let me just bring you up on the screen. There we go.
Adam, g'day. Good to be with you, mate. Great to be with our viewers too. Thanks for tuning in, everyone. Appreciate it.
Absolutely, and there's lots to cover this evening. But first, our standard disclaimer. We are licensed by ASIC to provide general investing advice only, so bear that in mind as you put questions into the chat. I see there's a couple there already, which is great. And we'll proceed on to those over the next hour. But first, today's big news. Headline inflation, as calculated by the Bureau of Statistics, is now running at 3%, which is higher than everyone expected. Scott, what is the fallout of that announcement today?
Man, messy numbers. I'm the optimist, mate. You know what I've been saying for 3 or 4 or 5 years now? I can't wait to be the guy giving the good news for a change, right? It'd be nice to be able to go on TV or Motley Full TV, excuse me, and give some good news. The best news was the trimmed mean inflation. Now, trimmed mean, I've said this before, mean is the average, what the Boffins call the average. The trimmed mean is, I think, the outliers off. The big bits, the ones that are up a lot, ones that are down a bit, take those off. The middle 70%. The average of that fell from 2.7 to 2.6%. That's a positive. It's in the middle of the range. It's going down. That's all good. That's where the good news stopped. Because the headline rate, as you've already mentioned, mate, went up from 2.8 to 3%. Here's the worst one. CPI excluding what they call the volatile items, fruit and veg, automotive fuel, holidays, that went from 3 to 3.4%. Now, if you're watching this thinking, oh, that doesn't seem too bad, that's because we all got recency bias. The number's been so bad recently, 3.4 seems okay. At any point in the previous 45 years, 3.4% would have been panic stations. Now, I'm not saying we should necessarily do that. What I think we need to keep in mind is just because they've been better recently, just because they've been higher a little bit longer ago than that, doesn't mean these are good numbers. For anyone watching with a mortgage, I apologize. I don't know what the RBA will do. You're probably asking that in a minute, Adam, and you know I don't like predictions. I'm not going to give one. What I am going to do is say that if I was the Reserve Bank next week, there is not a chance in hell I would cut rates. And frankly, the Melbourne Cup Day, which was the favourite for a cut, they may still do it. I don't know what they will do. But unless the inflation numbers come down meaningfully between now and then, I don't see how you cut rates. Now, if you've got a mortgage, you're thinking, well, hang on, that's awful. Yes, it is, absolutely. But the simple reality is what would be worse than delaying a rate cut is cutting early and then coming back 6 or 12 months later and putting rates back up again. That would be a confidence killer. That would really, really, really hurt recovery, right? Because we can all deal with the pain if we think things are going to get better. That's how things work. We think they're going to get better. We're spending's up. We've talked about lots of economic indicators this year, Adam. We're only in September, plenty of time to do more of that. GDP is up. Household spending is up. So things are kind of improving, which is great. But the problem is inflation has, again, popped back up. I hope they don't cut next week. And I hope, they don't cut in November unless the data is much, much better by then. Otherwise, we are absolutely courting, not disaster, but courting the risk that we have to then put rates back up sooner rather than later. And that would absolutely, as I said, they'd kill confidence, they'd kill activity. We're back in that cycle of, oh my God, now is it going back up again? All those reasons we don't want rates to fluctuate much. Taking their time, just making it a little bit cooler, hopefully get inflation back down. I mean, look, frankly, they could have to put rates up anyway if inflation keeps going up. So it's not out of the realm of possibility. But yeah, pretty ugly. Housing was up 4.5%, food up 3%, alcohol and tobacco up 6%. Energy up 26.4%. That's basically just the roll-off of the subsidies. 2 months ago, it was -6. Now it's plus 26. Why? Because the subsidies that were there 2 months ago aren't there anymore. That's the way these things go. So you kind of got to strip that one out a little bit. Insurance is really good news, by the way. I'm trying to find some positives. It's down along now with general inflation at 3%. Now, again, 3% is too high, but it was running at sort of double the rate of general inflation for a long time. So the fact that's now come back down to sort of staying low, that's pretty good. But energy costs impact everything. They are an input cost into everything. That's bad. Housing's obviously bad for obvious reasons. Food at 3% about average, but still too high. So, yeah, I wish I had better news, mate. I wish I could be more positive, more optimistic. I'm still optimistic, by the way, long term. But I wish I could say more nice things about these numbers. They were a shock. They were higher than most people expected. They're just high in general, and that should be enough, frankly.
Yeah, and I remember discussing those energy subsidies back whenever it was. And, and at the time we thought, everyone will be smart enough to ignore those numbers. Do you get a sense that we just haven't been?
Yeah, probably because energy's gone up anyway. I mean, the subsidies that were put in place, meaningful subsidies. They did push inflation down 6% in the year to June, I think it was. Yeah, June, July, August, June. So that was. I mean, there was some slight benefit. The problem is the underlying costs are going up. So the subsidy pretty much just, rather than lowering costs, kept them roughly flat. So when the subsidy goes away, we have this massive jump up again. We've talked about sticker shock before. That's the problem, right? The confidence is all about perception. It's all about sentiment. And you see that energy cost jump up, and all of a sudden it's like, oh my God. Now, we should have expected it. We did expect it. And the rational parts of our brain go, oh yeah, of course. The irrational parts, the emotional parts, the sticker shock parts go, what? How much? An energy bill going up by 25%, 1/4 more than you paid this time last year. It's an extraordinary increase. And there's policy reasons for it and all that kind of stuff. But just even allow for that. The fact those things go up, that's what people remember. That's how they act. By the way, the other thing about confidence is, I've said this before, confidence is a virtuous and a vicious circle. If you feel good about the future, you're going to spend and hire if you're a business. Why? Because you expect the future to be better. And when you spend and when you hire, when everyone else does the same thing, guess what? We create those circumstances that are better because we hire more people, we spend more money, that adds money to the economy, creating the virtuous cycle. The flip side is also true. When we go, oh my God, how expensive is everything? I'm not spending money. What happens? We don't spend the money, the economy tanks. We say, I told you it was going to go terribly. And then it becomes a vicious circle. So that combination is really, really, it's important. It's dire. It's painful if it happens. Consumer confidence, by the way, not great over the last couple of weeks. Had been trending upwards pretty nicely, but the Roy Morgan numbers were down. So economically, we're kind of, it feels like we're in the lee of the storm, I think. And it could go one of two ways, right? The storm blows away or it blows back towards us. I'm hopeful that there are better things ahead. There's a couple of good indicators which are positive. Household spending's up. That's great. GDP's up a bit. That's pretty good. So the broad momentum is good. Whether or not we kind of snatch defeat from the jaws of victory will depend on kind of what happens next.
Yeah, and you mentioned hiring. Last week, employment figures were also weaker than expected, not by much. Yeah. Employment rate holding steady at 4.2%. But as you mentioned to me earlier today, we've been seeing some big layoffs, notably the big four banks, BHP, announcing job cuts in their thousands. And as you said, despite that, household spending was up in July. Is it a case of we need to wait until these layoffs actually find their way into these reported figures? Or does that give us a bit of insight into what's coming?
I think we do, mate. I pulled up the numbers just quickly on unemployment. So the rate stayed at 4.2%. And the headline is, oh, that's okay then. What it doesn't account for is the fact that people left the labour force. Now, I don't want to get into too much detail on a Wednesday night at 7 o'clock Sydney time, but last month we lost 5,500 full-time jobs. Total jobs. That's not massive, but it's backwards. And there's more population. What saved us outright was the participation rate fell from 67 to 66.8%. Now, let me do the maths really quickly and really unboringly, hopefully. The unemployment rate is measured, the number of unemployed people divided by the number of, brackets, unemployed plus employed, right? That combination. And unemployed for our purposes is the number of people actively looking for work. So it doesn't include pensioners, doesn't include carers, doesn't include stay-at-home parents, doesn't include someone who's, richer than God and doesn't want to work. It only includes those who are working and actively looking for work. That combination is the so-called participation rate. So 67% of total adults in Australia were either looking for work or working last month or the month before. This month, 66.8%. So 0.2% of us dropped out of the labour force. Add that back in, and the unemployment rate would have gone from 4.2 to 4.4%. Not massive, not dramas. Again, I'm not going to overstate this stuff. I'm not a panic merchant, not someone who wants to scream the headlines. But that would have been the real number. So we're saved by the fact that people who were looking for work last month stopped looking for work effectively. That's what saved us. People got so discouraged or won lotto or got an inheritance and decided not to look for work anymore, whatever combination of factors that were at play there. That's what saved us. So back to the announcements the last couple of weeks. Atlassian, Commonwealth Bank, fired then rehired some people because they said AO would fix it. It didn't. Westpac, ANZ, 4,500 jobs announced. NAB, 410 jobs announced today. Westpac, 200 jobs announced. There was a report a couple of weeks ago on the Fin saying they thought between 1,000 and 1,500 might be laid off in a total. So whether there's more to come from Westpac, I don't know. BHP mine closure, 750 workers. Another mine in Queensland, I can't recall where it was, 200 workers. Now, I wrote about this today. You might have seen the email today. I want to be, that feels like a lot. It feels like a trend. I want to be really careful. This could be just one-offs, specific, isolated, separate, different. That might be fine. Adam, you mentioned before your background is IT, and lots of layoffs in the IT space and the tech space as well.
Yeah, absolutely. Yeah, it's that's always been the canary in the coal mine in corporate Australia, hasn't it? And that's absolutely seems to be the case. If anything, my colleagues have got to say has anything to do with it.
Now, as an investor, and again, I wrote this today. Hopefully, you've read the email, read the article. There's a couple of things going on there. Firstly, job cuts are awful if you're impacted. They are not necessarily as awful. It sounds horrible to say. If you're an investor and the company simply got too many people, right? If they've grown too big, if they become too bloated, and they realize that and can remove some cost, in this case, it's people, and it's a real issue. Right? I'm not being callous about it, but that's good for business. It's actually good for productivity too, by the way. If you can do the same with less, and those people can then go on to find other jobs, that's actually a real net positive for the economy. So we get into that if you want to, but that's positive overall, as long as those people can find other work and other productive work. So that's not necessarily a terrible thing overall for the economy. Now, some of those people won't work again. Some will struggle to find work. Lots of social impacts and emotional, physical impacts that come from being out of work and all that kind of stuff. So that's a big and different topic. So maybe it's that. I fear that, as I wrote today, it's actually about businesses that can't find growth. Now, Myer was out yesterday. It's like-for-like sales up 0.5%, profit down 30%. Why? Because your fixed costs are the same. Your variable costs per product go up with the sales growth, and you're only growing top line at 0.5%. Your costs are growing faster than that, particularly if you're a retailer with low margins. That is an absolute disaster. Woolies had the same problem. Modest to ordinary sales growth. If you can't cover the growing costs, your profit's got to go backwards. You've got no choice. Now, you can cut costs once. Maybe you do it twice. But at some point, that's kind of the trick. You can only play out of the bag a couple of times. Because at some point, you've just simply you've cut as hard as you can. At some point beyond which you lose sales, you lose customers, you lose revenue. And so it's a neat trick to play for a little while. And I suspect the banks, I suspect the retailers will be trying this because they are trying to find a way to make up for that cost inflation that's not necessarily being covered by increased sales, increased prices, increased volumes. That's kind of what's going on. That's why I suspect, and again, I don't do predictions, mate, but I suspect this is not the last time we talk about meaningful large job cuts in corporate Australia. And by the way, ANZ gets the headlines because it's a massive bank with 43,000 employees. Individual small businesses with 2, 5, 10, 15 people are going to lay off maybe one person, maybe two people. You see that happen across the economy at scale, and that's the real risk. Now, if we're lucky, growth in household spending, growth in GDP absorbs some of that layoffs, and that would be that's the Goldilocks solution. I want to be a little bit careful in assuming that because, as I said, the unemployment number last month, if we'd done it on the same base, would have been 0.2% higher. That's before these cuts were not even announced, but actually then eventually some point roll through. So again, I'm not being negative Nancy here. I'm not trying to say it's going to be terrible. I do think we are in that lull of businesses trying to grow. And my suspicion is the last financial year they went, we did our best. That's all we could do growth-wise. Okay, guys, time to look at the costs. Let's pull the books out and see what we can save. I think that's probably where a decent chunk of corporate Australia is. Again, as an investor, not the world's worst problem to have. It may even be a net positive over time, as long as that doesn't create the vicious circle, I talked about before, when it leads to lower spending, in which case that becomes problematic and that can presage some more negative economic consequences.
Sure. Okay. Now, two more numbers that aren't behaving themselves or aren't behaving in the way that we're used to seeing them behave. We've got the ASX and other stock markets around the world all at or near at record highs, while gold is also at a record high. Don't normally see that. So how do we explain that?
This is mad, right? Really fascinating. And the first thing I'll say is, I suppose, cliches are cliches, stereotypes are stereotypes, generalizations are generalizations, because they tend to have been true in the past. We shouldn't assume they always are. But generally speaking, people invest in equities, share prices go up when they expect the future to be bright. When they think it's going to be great, more profits, more sales, higher share prices, the economy's booming. When they're worried about instability, inflation, collapse, money printing, general uncertainty, they go to gold because it's considered a hedge against inflation. It's considered a safe asset. I think that's a misnomer, by the way, for reasons we can go into. But that's generally the idea. People jump into gold when everything else is going to hell in a handbasket. And you've kind of got the both happening at the same time, which, as you say, is really, really unusual. Normally, you're getting out of shares into gold or out of gold into shares. risk on, risk off is the horrible cliche. This time around, you got kind of both at the same time. And I have no provable thesis on this one, but no one does, by the way. Anyone tries to interpret something in the share market or the economy, if the more certainty they have, the less you should listen, because no one knows for sure. I suspect what's happening, though, is people are looking for productive assets in the face of inflation, that is increase in prices, which we kind of call inflation. The other inflation, if you're a particular pedant and you like your monetary theory, and particularly if you're an Austrian economist, you see inflation as the increase in the money supply, money printing, right, effectively. Now, kind of both those happening at the same time. And some concern about what Donald Trump might or might not do in the US, what tariffs may or may not do to inflation. And so you've got this really weird scenario where it feels like both groups of people are reaching for a solution or a salve, the same issue, solved differently. And again, there's no way to prove this. So it's just my assumption, my assertion, my best deduction, which is, excuse me, sorry. If you think money printing and or inflation are going to continue, if you think economic instability is going to be a problem, what do? Well, you can go to gold because they're not making any more of it, much, 2%-ish a year, the increase in finding stuff in the ground, small amounts used in electronics, but really the amount of gold is largely unchanged. So if you're worried about the increase in money supply or inflation, gold's not increasing in theory. More money, same gold means higher gold price. That's the theory. That's why you go to gold inflation, or what some people do. I don't think it's a good idea, but that's why they do. Others are saying, well, hang on, I want to preserve my purchasing power. How do you do that? Well, you buy something, an asset, that increases faster than the rate of inflation. What is that? Generally, company shares. We know the market tends to go up about 9% a year, about 6% in real terms after inflation. So if you're looking to preserve your purchasing power, maybe you're jumping into shares, maybe you like the dividends, but you probably just want the capital gains. You like real businesses. You want to find some way of staying ahead of that inflationary pressure. And I suspect that's kind of what's going on. So the same kind of issue at the same time. You're not getting much in the bank. Maybe you're covering inflation, maybe you're not. So what do? You find either a growth asset or a safe asset. And I suspect the same motivation is impacting two different groups of people who are seeing the world very differently, frankly. The gold bugs tend to see the world in, I guess, this is a horrible generalization, negative terms. They say, well, everything goes badly, I want something. The investors in shares, I think, generally speaking, are optimists saying, well, if inflation's there, at least I want to preserve my purchasing power. I want to have a growth asset. So it feels to me like the same thing is happening, or the same impact, same impetus, I should say, executed two very different ways in two very different asset classes. Because, and by the way, this is probably most of you won't know, the bond market, which is just a fancy way of saying government debt and a bit of company debt, is actually multiples of the size of the equity markets. So you and I live in shares every day, Adam. The equity markets are big. The bond market, the fixed interest market, the government debt market is hugely, much bigger. Bigly, some might say. And so that if money's coming out of that market, I can't get a good return on bonds. I'm getting a couple of percent. I fear inflation. Maybe I go backwards. I need another asset to find. You've got money coming from a big market to a smaller, still a massive but smaller market. That will have distortionary impacts on prices. So when I say distortionary, by the way, I'm not saying bubble necessarily. I'm just saying when you see money rush into those asset classes, that's why they both go up at the same time, because money's coming out of bonds into a higher return, or hopefully higher return environment. I suspect that's why we're seeing it. But again, mate, no one can prove it. That's my best guess. That's what I think's going on.
All righty. Okay, so now we're going to move on to, we promised we'd talk about three factors that we think could propel the ASX beyond record highs. Now, I'm going to give full marks to TC, who's a bit of a regular.
Hey, TC.
He has nailed the first one. He said, if super growth continues to outpace the economy and a decent proportion of this enters the ASX, is it reasonable to assume that PEs could remain permanently higher from the weight of capital?
Forever's a long time, TC. Permanently is a long time. Nothing is permanent. Death and taxes. Politicians lying, maybe. No, is that too cynical on one side? I'm not sure. What sets prices in the from a mechanical rather than a fundamental perspective is flows of capital. And so when you've got an unusually large flow, demand exceeding supply, we've talked about that before, you will see prices go up. Probably we're seeing the super increases largely, yes, it's wage increases, but that's not enough to make up for company profit increases, right? The amount of money we're earning is not growing faster than company profits. So profits are always going to have a more fundamental impact. But the change to the flows, and particularly think about your TC, you're probably talking about super going from 11.5% to 12% on July 1, or has just July 1 just gone. That increases meaningfully the proportion of our pay that's going into the share market as a result. So yes, from a one-off perspective, there will be a meaningful increase in the amount of money chasing a limited number of assets. Couple of things to bear in mind though. Permanently, no, because at some point that demand will flatten again. And so permanently higher, I don't think so. The other reason I don't think it's permanently higher necessarily, by the way, I'm also not saying share prices will fall. I'm just saying, higher PEs. PEs in Australia are important, but TC, I'm sure that Australia is 2% of the world's stock markets. That increasing amounts of Australian superannuation is going into property, fixed interest, infrastructure, private equity or privately owned businesses, and international shares. And so we're 2% of the world's market. We are, massive at home, not very big overseas. And so I suspect that because capital is largely global, because valuations, if you're a big super fund, you can put your money anywhere. You can go from Canadian dollars to American bonds to European stocks to Australian property and back again before morning, right? So I suspect that if there is a meaningful distinction between Australian markets and overseas markets because of that super, the arbitrage will find its own way out. If I can buy shares in the US cheaper than here, I'll do that. So I suspect there is going to be some volatility, just the flows will probably make some problems. Do you think it's going to be permanently higher? I really, really, really doubt it. If we're in the US and we had the US stock market, and if the US workforce earned Australian style inflation superannuation, yeah, I think that's probably for a decent amount of time probable, and they don't have the ability to defray that meaningfully. I think though over time the ability for international investment opportunities to be tapped by Australian super funds probably means that permanently is probably not likely. I'm not sure what's happening now, honestly. You look at it, there's no sense that Australian PEs, for example, are meaningfully higher than the US. In fact, there's an argument that's the reverse. Now, very different composition of their market, lots of tech, more retail, here more banks, more miners, lots of reasons why. And this is the other part of trying to unpick this. It's just really hard. Just stupidly hard to try and work out a single factor and exclude every other possible imputation and permutation. So increasing flows will absolutely push share prices higher than they would otherwise be in the short term by a bit. Do I think it's permanent? No. Would I try and trade it? No. When it normalizes up here, is going to come down. All things being equal, a little bit, but all things aren't equal. Maybe the economy is booming by then. Maybe banks are making a fortune or losing a fortune. Maybe the oil price is sky high. Maybe the iron ore price is through the floor. There's so much else at play. Isolating that factor would be hard enough, and even if you could, would it be big enough to offset everything else? I very much doubt it, mate. So, but it is a factor. It's absolutely a factor. It is more money going to the Australian stock market than this time last year. Wages are higher, a higher proportion of those higher wages. Yes, absolutely. It's got that money's going to find a home. So expect a little bit of volatility because of it. I don't think it's permanent. I mean, it might be. I don't think it will be for those reasons. And I don't think we should try and second guess or trade it because I don't think we can know how that plays out in time.
Yep, and obviously we're not trying to trade this. These are sort of long-term factors that we discussed earlier today, Scott. And obviously the second one we were talking about is interest rates, but as you pointed out earlier, maybe these interest rate cuts that we've all been expecting might take a bit longer or possibly not even happen.
Yeah.
And this isn't a question about interest rates, by the way. This isn't just me sneaking it in.
Sure.
And you had one more, which is just generally more money in the economy. So where does that money come from?
So, oh man, that is a deep rabbit hole. Where's the money come from? So look, I think it's always a good time to buy shares, right? If you look back over history, the Vanguard index chart for the last 30 years, the Credit Suisse research goes at 906. When's been a bad time to invest? Never. Could I pick, if I had hindsight, could I have chosen the tops and the bottoms? Of course. But the market has always gone on to new highs. I say this almost every time we chat at them, and I'll keep doing it because I really, really, really want our viewers to know. The market has never yet failed to regain, then surpass a previous high. In other words, if you bought the index at any point in the past, you've made money. And if you dollar cost averaged, maybe you bought it at the top in 2007, but you probably bought it at the bottom in 2020. And, right? So the market goes up over time. It just does. Will it always? I can't promise that. Do I think it's likely? Yes, for my lifetime and probably everyone else watching. So that's really important. Where's the money come from? I think now is a good time to invest in general, always. But superannuation contributions are going up. Wages are going up. The economy is growing. GDP is increasing. Household spending is increasing. And rates, while they may or may not keep going up or down from here, have come down already over the past 7 months, 8 months. The combination of those things, lower interest rates mean higher asset prices. More economic activity, generally more revenue, generally more profit, generally higher asset prices. More superannuation money going into the market, generally more demand, the same supply, generally higher asset prices. Now, this is not trading. This is not me timing the market. I'm not saying, I've been waiting for 15 years and now it's time to invest. If I've been waiting for that long, I've made an absolute terrible decision because I missed 15 years of increase. But what I really want to just mention is, I don't know what happens in the short or medium term, right? Those trends are going to play out. Could there be a US-led recession globally? Yes, of course. Could tariffs lead to massive inflation booming again? Yes, absolutely. Are they going to? I don't know. In the short term, anything can happen. In the medium term, most things can happen. In the long term, price follows value, but also that value is going to be a function of the available assets and the money chasing those assets. So I'm not saying mortgage the house and kids. I'm not saying go and take leverage. I'm not doing any of that stuff. What I am saying is there's very, very, very good reason to believe that the future is brighter than the present. Not even just the past, but the present. For those three reasons and more. Again, innovation we've talked about before. We've talked about human ingenuity. We've talked about democratic capitalism. We've talked about all those things. Add all that together, I think now is a very good time to be. Even, by the way, the market's out on new record highs. People are saying, well, surely it's time to sell. I don't think so. Not because I don't think it's going to crash. It could do anything. The market might go down 20% tomorrow morning. Now, if it does, I'm going to replay this and cut out the might bit and look like a genius. It's probably not going to. It's almost certainly not going to. The reality, though, is that over time, the factors that are at play in general, but also specifically right now, do, I think, give us a very good chance of doing very well over the long term. So that's, if you kind of look at the market saying, what happens next? Maybe it crashes, maybe it doesn't. I don't know. Are we in a bubble? I doubt it. Is the market more expensive than it was 12 months ago? Yes, absolutely, very clearly, empirically. Do I think we'll still do very, very well investing today and tomorrow and next month and next year? Yes, I absolutely do over the long term, 5 years plus, because that's very likely to happen. And those particular trends are at play right now. Now, is every stock worth buying? No. Clearly not worth buying. At Motley for Share Advisor, the service I run, some of our viewers hopefully are members, we've made some sell recommendations. Not because of timing the market. We just looked at the price and went, I love the business, but man, that price? No, I'm not paying that price. At the same time, we're finding things to buy. We're putting out a brand new recommendation tomorrow after the market closes, about 21 hours from now, which again is not an ad, but if you want to join Share Advisor, please feel free. Those things, because we're finding value, and that's the important part, right? So when the markets, I hate the stock pickers market cliche because it kind of always is and it never is. ETF, you'll do really, really well buying ETFs. Dollar cost averaging ETFs over time, you'll do fantastically well. But when the market is higher rather than lower, not records or just higher, if PEs are higher, if valuations are higher, you just be a little more careful. There are likely to be more companies overvalued now than there were when the market was 15% lower, just because maths. And so that's really important. So I think it is a stock pickers market now, which I hate saying because it feels self-serving, and it kind of always is and it kind of never is. But I reckon now's a great time to be looking and saying, what's too expensive? What do I need to give a miss or even sell if I own it? And I hate selling. I'm a long-term investor. I want to hold positions for years and years and years and years and years and years because the business is high enough quality, they'll pay us back in spades. But at some point, you get offered a stupid price by Mr. Market. It's like, hey, would you like me to pay a stupid price for this business? I'm like, well, I mean, I'd rather keep it. But if you're going to offer me that price, I kind of have to take it because that's just dumb not to. So that's where we've been with some of our companies. But we're also buying where we see value. And I think there's still enough of that around to make me feel pretty good about making recommendations for our members. So kind of keep those two things in your mind at the same time. Yes, the market is high. Yes, some companies are almost certainly overvalued right now. But don't let that convince you either get out of the market, to not invest, and not try and find companies worth buying because there's plenty out there.
All right, and once again, TC is doing my job for me. So we're going to drill into that exact question with one specific company, which is Pro Medicus. And nice. I'll remind you, ticker codes around here. We prefer business names because we're investing in businesses. We're definitely not investing in ticker codes. But anyway, I won't harp on that. So yeah, TC's follow-up. How do we deal with high-quality ASX companies like Pro Medicus at extreme valuations if they're just too expensive to buy and too good to sell?
They're not both. TC, intellectually, they're not both. Emotionally, and I'm in the same place as you, trying to go, oh
And
my
from
goodness,
a
what
tax
do you do
point
with
of
this?
view,
Yeah, right, totally, 100%. So, and actually, the taxing is a really, probably about time. That's a really great point and really worth kind of digging into at some point. Here's the way I try and think about my portfolio and our services for our members. Is to try and do the mental exercise of, if your stockbroker rang you at 9 o'clock tomorrow morning and said, TC, got a confession to make. We accidentally sold your entire portfolio last night. Good news is you got the cash. Bad news is you don't have the shares you used to own. But because it's our mistake, we won't charge you brokerage. Do you want me to buy the same portfolio back, or do you want to make some changes? Now, it's one thing, the endowment effect is real. The endowment effect is a psychological bias. Is because I own a thing, I think it's worth more than if I didn't own it. And the research is done on coffee mugs, funnily enough. There's some great research where the people who owned coffee mugs thought they were worth more than those who wanted to buy them. So if you gave people a coffee mug, gave people some money, people wanted to sell them, oh no, it's worth $5 or $8. People want to buy something, I think it's only worth $2 or $3. Now clearly, and it was statistically proven across the whole group, if you already owned it, you wanted more for it, you were prepared to pay. If you didn't own it, that's the endowment effect. You already have it, so you think it's worth more. But if you go through that mental exercise of, if they sold your ProMedica shares tomorrow or tonight, TC, and tomorrow morning called you and said, mate, sorry, do you want to buy back? Here's your money. You've got $1 million worth of ProMedica shares. Well done, TC. Do you want to buy them back at the same? Do you want to buy back the same number? Do you want to buy back them at all? Do you think it's worth buying? That's where you've got to mentally do the whole, I don't want to sell, but it's too expensive to buy. It can't be the same thing, because the future returns from ProMedica from here will be whatever they are. Maybe it's plus 10, maybe it's minus 10, maybe it's plus 100, maybe it's minus 50. I don't know. Whatever they are going to be, there'll be that, no matter whether you own them or not, whether you buy or sell them or hold them today, the future return is the same. Quick insight. I tell the team all the time, I really hate hold recommendations. We have some of our services that I run. I don't like them because it's a bit of a cop-out most of the time. So, well, is it going to beat the market or is it not? Hold is like, well, I don't know. What do I do with that? I could sell those shares and buy something more attractive, or I could buy more of the ones you tell me to hold. If you tell me to hold them, what are you telling me? Now, we do it sometimes because valuation is really, really, really uncertain, right in the middle, or because we're waiting for something to happen to those businesses over time. But I generally prefer to buy or sell, because at the end of the day, the money is fungible. If you went to cash, what do you buy back? Long setup. As a general idea, I would think about ProMedica or any company in that lens. If I sold my shares, or if my shares sold for me, would I buy them back tomorrow morning at the prevailing price? If the answer is no, that tells you, I think, what you need to know. If the answer is yes, then that tells you what you need to know as well. The difference is tax, and Adam makes a really, really, really good point. ProMedica has gone up so much, I'm going to pretend that your cost base was effectively zero. And I'm going to pretend you're on the highest tax rate, just for the sake of making my maths easier. You're going to pay 25% capital gains tax, right, roughly, on that sale. That means that the company you then invest that new money back into has to effectively do 1 1/3 times as much as the shares you used to own, because you've sold $100 worth of shares, you've now got $75. The company at 100 got up to 10% or 110. To go from 75 to 110, you do a massively larger amount of heavy lifting to get that same increase. Now, the tax is payable eventually. We get into the tax maths at some other point, plus the dividends if your company's paying dividends. But broadly speaking, just make sure you realize if you sell and pay tax, you're reinvesting in after-tax proceeds, which are less by definition. So that's, to Adam's point, really, really important. ProMedica is hard. I don't own shares. I personally wouldn't buy shares today. If I owned them, I would sell them. Others in our team disagree. Others in our team think they're worth holding. And why do I give you both those views? Because we're Motley. It's not just a tagline. It's not just a funny name. It's a funny name. It's not just a funny name. We don't tell our team what to think. I don't believe in decision by committee. In my services, I make the calls, not because I'm necessarily always right, but because someone's neck is on the line, someone's name is on the door, and it's my responsibility. But our other teams doing other services, I also don't tell them what to do, because it's their responsibility. Decision making by committee might save you some rough edges, but it also takes off the good positive edges. It dulls the blade. Let me mix my metaphors. So you want the sharp blade. And you're going to have to take some rough edges with that, because that's kind of the way it works. That's what we do at the Motley Fool. So ProMedica is a really, 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 really tough one. It's a super high quality business, growing really nicely. At the same time, the P is 280 times earnings. That's going to do a lot of growing just to justify the price. I can't make it work. Others in our team can. That's a very unsatisfying answer, TC, but that's mine. If I owned the shares today, I'd sell them. If I gave my shares to some other people in our team, they'd keep them. And that's just the reality. Why? Because they believe that the long-term future is brighter for ProMedica than I can make myself believe. That's what a market does. It's the different views make a market make sense. We'll see in time whether I'm right or whether they're right. I am not arrogant enough, or hopefully not arrogant enough, to believe I have the right answer. Other people have very strong convictions on their views. Here's the other thing. We've done pretty well at the Motley across our services with very, very different investing strategies. So you don't always have to have the same view. The right strategy executed well, even if it's a very different strategy, can still deliver really, really good results.
All right, next question about a business which is definitely not at record highs. In fact, Woolworths.
Oh, yeah.
Back to about, hasn't been this low since 2019. So any comment on the Woolies share price?
You know what's really hard about Woolies is the word fall. And the question really isn't so much. Let me try and backtrack this. When you value something, you should be asking yourself, what's it worth? And then asking what the share price is. And if it's worth 30, but selling for 25, you buy it. If it's worth 20 and selling for 25, you don't buy it because it's worth less than the price. When a price falls, we're inclined, some of us, by the way, think, oh my God, this thing is falling, I'm staying away. Others of us think, oh my God, the price is falling, it's now a bargain. I'm going to tell you to ignore both of those, please. Because the only question really is, what's it actually worth? Let's pick, let's assume Woolworths was $100 a share and it fell to 50. Okay, well, at 50, it's clearly overvalued. At 100, it was even more overvalued. And because it fell, it's less overvalued. It's not necessarily worth buying. So a big fall doesn't necessarily make it worth buying. On the other hand, if it was worth, what's the share price now? 27. If it was originally 30 and you thought it was a 35, then it falls to 27. It was cheap. Then it's even cheaper now. So of course you'd want to go and buy some more shares. But that doesn't, just because the price falls doesn't mean you shouldn't. One of the great lessons from David Gardner, one of the Motley Fool's co-founders, is buying as the share price increases because you've got a great business. So I bought shares in company. I bought shares in Amazon. I'm not big noting myself here, a few years ago. And I bought some more as they went higher and more. I think I bought 3 or 4 times. And each time the price went higher than before. But looking back in hindsight, each time was a great idea to buy. So if I'd waited for the fall, I would have missed the gains. Woolies is currently 34 times earnings even after that share price fall. So what does that tell you? Well, it tells you a couple of things. Firstly, profits have already fallen, so it's allowing for that. Secondly, I would suggest that the price previously was simply way too high. We talked before about the fact that gold and shares are both expensive. The so-called flight to safety that really started during the worst of the COVID lockdowns and kind of continued, saw some of these companies go to stupidly high multiples. Woolies, just crazy prices, or just way too high. Why? Because everyone thought, oh, it's a defensive company. It can't go wrong. I'm just going to buy Woolies. Now, by the way, a defensive company, I mentioned this kind of in passing before, $42 in 2021, now $27. Still a very defensive company, but a really expensive investment decision at 42. Now it's 27 over, what's that, almost a bit over 4 years. So the safety bit you thought you were buying has cost you money. And that's not to bag anyone. I don't know if you, Carl, if you own the shares or not. I'm sorry if you do. I'm not picking on you. Just because it's fallen doesn't mean it's great value. I would love to buy Woolies at a cheaper price. I suspect that last year's profit for Woolies is lower than its long-term future profitability because they had some one-off issues that, frankly, they couldn't deal with. Back to our first conversation, sales didn't grow fast enough to cover rising costs. That's just rule number one. I suspect Woolies is too good a business not to solve that problem. If and when they solve that problem, profits will grow. That brings the PE down. Let's not do the maths too much. Price divided by earnings. How does the price? How do you get a better value? Well, the price comes down, it's better value. The PE falls because the price falls. Or if earnings rise, the PE also falls. That's where the maths works. So it's 34 times earnings now. If they grow earnings, that PE is going to come down. 34, 32, 30, 28, 27, whatever the number comes down to. I can't buy Woolies at the current price, even with the fall. I thought it was overvalued at 42. I think it's overvalued at 27. Personally, others will disagree. That's okay. I would love to buy Woolies. I think it's one of the very best businesses on the ASX for its defensive nature. Generally speaking, in store, they get it right more often than not. They have the occasional stuff up. Remember Masters, the hardware chain? That was the last time the price went down to, what did it fall to? Here you go, $17.79 I've got in 2016. Now, so it's up meaningfully from there. It more than doubled from there to the highs. So you want to buy good businesses when they're available at good prices. Woolies is a very good business. It's not a very good price in my mind at the moment. I wouldn't necessarily need to wait for single-digit PEs or anything stupid because I think profits will go up. But I don't I can't see myself buying it above $20 until or unless profits improve markedly from here.
All right. Interesting that with the ASX near record highs, we're discussing businesses which are nowhere near record highs. So the next one is Domino's. We've got
I knew
Deepak
someone
asking
asking about that. Thanks, Deepak.
Yeah, and look, as a follow-up, I'd be interested to see if so they announced, I think it was last month, they announced that they were going to reduce their super discounting model, which I'm really interested. I've got teenage kids, so I'm pretty in tune with Domino's discounting, activities. Yeah, I'd be interested to see what your thoughts are on both the share price and whether that's going to be the thing that pulls them out of it.
I have said before, we get this question a bit. I own shares in Domino's. Domino's is way too good a business to be this cheap. They have executed horribly. And there's a real question to ask, and apologies if I'm repeating something I might have said last month, but you've got a really great business model and you've got really poor execution. Now, broadly speaking, my view is a good business model will win more often than not, and probably far more often than not. Because eventually you get someone who can execute what is generally a good idea. I won't give a hackney example. I'm just going to try to think of a good analogy. Something that's normally going to work properly, this is being screwed up. You're going to push the person like, hang on, let me do this. I'll show you how to use it properly, right? That kind of idea. It's like a power tool, right? Me using a power tool, probably bad. Someone pushed me aside and said, Scott, here's how to use it. Oh, that actually works really well. It wasn't the tool after all. I suspect the Domino's model is brilliant. You are getting a really cheap to make product. It's super transportable. It's made for delivery. The store footprint is tiny. The more you sell, the more other outlets you can open and kind of infill between them. That's a really nice, I spot a lot of vicious and virtual circles. Really nice virtual circle because you get it hot, you buy more of it. You buy more of it, something else opens closer to you because they can afford another store to be put inside that catchment area. So it comes to you even quicker, even hotter. So you're even more likely to order it next time. That virtual circle is a really, really attractive one. Really super great economics. The model is fantastic. They've screwed it up. Here's the other thing. They haven't screwed up in Australia and New Zealand. The problem with Domino's was they decided to expand overseas. Hand up, I thought it was a good idea to try. I'm not convinced they made a mistake in trying. They definitely made a mistake in not getting out of it quickly enough, not fixing the problems. And eventually, the chairman, Jack Cowan, who's now the executive chairman, he's Jack of Hungry Jacks, by the way, for those who might not know that. He's one of the major shareholders in Domino's. He's now the executive chairman, basically pushed the old CEO out, said, out of the way, I'll fix it. You give me a good idea, thank you, but I'm gonna make it happen. And I love that, by the way. I love founder owners, and I love, iconoclasts might be a bit too far, but Jack's not going to brook any drama. He's going to get in there and try and make it work. Now, it doesn't mean he will necessarily fix it, but the guy's 85 and he's just there to, he's there to fix stuff, right? He's going to make things happen. So I suspect the odds are very good that better execution of what is already a very good business model is great for business and probably great for profits in the share price. They have to make some really hard calls. Shutting down or reducing meaningfully some of their international business is going to be great if they have the guts to do it. I suspect Jack has those guts, but he may not. We'll see. The Australian business is growing really nicely. Last year, same-store sales 7.5%. This year was minus 0.5, but over 2 years, same-store sales growth of 3.5% a year is excellent. Plus, they're opening more outlets. It's a massive cash cow, the Australian business. If you buy it without the saddle of everything else, it's worth a whole lot more than the current share price. So the bet is they fix the international business or close it. If they do that, the Australian business stays solid, it's worth meaningfully more than today's share price. Now, would I say that because I own the shares? Maybe. But if I didn't believe it, I wouldn't own the shares. So it's a bit of a circular argument to some degree. I think this is a very good business. I think it's a very good potential. The discounting, mate, you and I have talked about this. I'm not sure it's going to work. Woolworths have tried the so-called everyday low pricing before. No high-low discounting, just one price. Turns out the price is fine and the customers like it. But what's your excuse to talk to your customers? If you're not saying, here's my deal, here's my special, you're saying, oh, everything's still the same price it was. Please buy pizza. It's like, well, what's the point? So I don't love the strategy. Now, I hope Jack's right. I hope I'm wrong. People like us, by the way, people like me, I would say us, people like me in our peer companies, get a little bit too big for their boots. Analyst so-and-so from such and such a business comes and says, I think you, Mr. Businessman, should do this with your products or your prices. And you kind of go, that guy's working in the business. You're running the spreadsheets, dude. Let's, who's likely to know more about what's going on here? Doesn't mean that the analysts don't always have something to offer. I like to think I do sometimes. But I've worked in business for long enough before joining the Motley Fool that I think I probably have a more reasonable and rounded understanding of business and maybe some in our industry, if I can be a little bit unkind. So I hope I'm wrong. I hope Jack's right. I hope it works. I think price signal is important. Price numbers are important. If they can find a price point that is cheap enough every day, that is just a no-brainer, which might be the case, I think that's a really positive thing. If they do that but can't find a reason to talk to their customers, I get a text a couple of days ago, hey, it's Tuesday, buy a Domino's pizza. Now, it turns out I did, not for that reason, but the young bloke was home and my wife was away for work, so we did. Bought a Domino's pizza. But, you know, what will they send me an email saying, hey, it's Tuesday, the prices are the same again? I'm not sure. I hope I'm wrong. I don't think that's material, though, to the investment case. I'm not. If I thought it was a big enough deal, I would absolutely change my view. I think the shares are really cheap relative to the long-term potential of the Australian New Zealand business alone. If they can fix or get rid of the other stuff that's costing them money, just literally it's draining the coffers. I think it's worth more money. So I'm a fan. That's why I own shares. I could be entirely wrong, but that's my view on Domino's.
All right, moving over to the US now, and
Oh yeah.
Grandpa Barbecuer's Game Cat. We don't have any prizes for the best name, but if we did, this one would take it out. In fact, our US founder, David Gardner, has just written and published a new book. Maybe once we get a box of those, we might hand those out as prizes. So, yeah, you must have got into YouTube pretty early to get that, because I know that Google prefers real names now. Anyway, back to the question. Yeah, a bit of a veiled political question there, but just focusing on the result, which is what we want to do. What are your thoughts on America possibly devaluing the US dollar?
Oh, man, that's such a good question. How to answer that quickly? There is significant US traumas with their amount of debt they've got. The interest bill on their debt is about the second or third largest budget line item. That's the interest, not the repayment, the interest alone. That's extraordinarily high, and it's very, very, very close to unsustainable because they're making it worse rather than better. Can they fix it? Yes, in a heartbeat. You spend a bit less, you tax a bit more. You say, guys, Council of Wartime, we've got a real issue. We've spent too much money. We're living beyond our means. We keep adding on to the credit card. We've got to have to stop spending a bit, and you're going to have to go back out and do a bit of extra overtime and pay it off. At a household level, you can fix that easily. At a government level, you can fix it easily as well. There is bugger all political will on either side of the aisle, as the Americans like to say, to fix the problem. And so it gets worse. And at some point, there'll be some sort of come to Jesus moment. There'll be some sort of reckoning. And it could be a few things. Donald Trump's been arguing for low interest rates from the Federal Reserve. I think that's very myopic, because if the Federal Reserve drops their funds rate, doesn't mean that people buying US bonds are going to accept a lower interest rate. They're going to say, well, I want to be paid based on your risk of default. So whether Trump is successfully getting rates down is one question. Whether even if he did, it'll make a difference is a much bigger question. And then what does that mean? It means the US has to buy more of its own bonds. This gets really technical really quickly, and apologies for those who don't love this deep stuff, but it's kind of fascinating. So what does that mean? Well, maybe they're lucky and rates come down and the bill goes down and everything is fine. I think that's very likely, but it's possible. So let's account that as one option. They could literally technically default and just say the rest of the world, get stuffed, we're going to zero, we're not paying you back, we're resetting the scoreboard. I don't know what happens then. Russia's done it, Argentina's done it, Venezuela's done it. The US has never done it. They've kind of, other people say they've defaulted in other ways. It gets, again, very technical and esoteric, and people have their views on this on ideological grounds. They've never not paid the bills. And so that is a really big question of what would happen. Now, on one hand, you say they become an international pariah, we all walk away. The other hand, you say, well, they're the biggest economy in the world and with the biggest army and the biggest consumer economy. And what are we going to do? Are we really not going to trade with the US anymore? Or are we going to go like, well, that sucks, but can you please buy our wine and our beef and our everything else? I don't know. I just don't know what happens. So I don't know. The other is they devalue by printing money, which we try to talk about that with inflation before. Devaluation happens effectively by printing more dollars, same number of goods. The value of your dollars falls relative to your labor or the stuff you want to buy or you want to own. Effectively hyperinflation or just devaluation of the assets. So which will happen? I don't know. I'd love to think they just fix the fiscal problems. That'd be great, but they're probably not going to. Maybe rates go down and they get away with it. I don't think that's likely. That's possible. The money printing is probably. I don't think they're going to not pay the bills. Well, Donald Trump could do anything, frankly. I don't think they're going to say the rest of the world gets stuff. We're not paying the bill. What are you going to do about it? And that's the thing. What are we going to do about it? Nothing. We're going to say, well, that makes us sad. And then what? We're not going to invade them. We're not going to turf them out of the world economy. So I don't know. It must be war games somewhere in the US right now. Either way, I suspect there is no option but the US dollar being devalued against foreign currencies to some degree over some period of time, with whatever of those mechanisms they end up following. If the interest rates fall, the US dollar is worth less compared to other dollars with higher interest rates, so that pushes the currency down. If they print money, that pushes the currency down. If they devalue the currency, default, that kind of pushes the currency down. So I think that's the most likely outcome in the medium and long term. But I don't know that we can foresee it with any reasonable confidence. So I've said for ages people should invest in the US. More than half of my portfolio is invested in the US. And I'm sitting here saying, well, maybe that'll happen, and maybe it will. Do I think that's enough of a risk, a large enough risk, a long-term enough risk to not invest in the US? No, by definition, because my money's still there. I could be wrong again, like everything. I could be wrong. I suspect Apple and Coke and Nike and Berkshire Hathaway, which shares I own, and Amazon, who I also own, and Facebook and Nvidia and Tesla, and I suspect those companies go on doing really, really good things. And maybe there's fewer or more US dollars to buy those things. But do I think the end of the US economy is near? No, I really don't. Otherwise, I'd sell my shares and bring them home. At some point, if I felt like things were spiraling, I may. And at some point, we'll tell you if you think that's the truth, by the way, and that's the case. In the meantime, I think Howard Marks has got a great matrix. It's a simple 2x2 matrix. On one axis, let me spit that out, is important and not important. On the other axis is knowable and not knowable. If stuff is not important and not knowable, who cares? If it's not important and knowable, who cares? If it's important and knowable, great, do something about it. If it's important and not knowable, that's the fourth quadrant. Again, I won't say who cares, but what do? You literally, by definition, you can't do anything about it. So you've got to make your bet. If someone said, I feel so desperately scared of this, I'm going to bring all my money out of the US and bring it home to Australia, I'm not going to argue with you. I'm not going to say don't do it. I'm not going to, because I don't know what happens next. I do think that the chance that in 25 years, the US economy is bigger, US companies are bigger, the US stock market has done really well, I think odds are very, 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 very good. And so if you try and time the market, good luck to you. And if you're not trying to time the market, you've got a long time horizon. I don't see the evidence yet to change investing strategies as a result. I hope that helps. It's a difficult context. It's really, 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 really detailed, but I hope that's a reasonable discussion. And I hope that's a reasonable view. I think in the end, democratic capitalism wins. I think the power of human ingenuity wins. I think the US companies that are doing amazing things around the world win. I suspect that's why I think that's the answer.
All right, next question from Hassan, and it's on the same topic, and we kind of skated around it a little bit, but okay. He's asking why the share market in Australia is lagging behind the US.
Oh, good question. Really, really good question. Over 100 and something years, the Australian market is the best performing market in the world, up until 2023 or 24, the latest Credit Suisse numbers I saw. So that's a bit of bragging rights, right? We'll take that one. But only by a little bit, and only a bit ahead of the US. The why, so there's why has two answers. Like is it justified? But also just what's the maths behind it? I'll do the maths bit because that's the easy one. The investment community is more excited about US tech than Australian banks. Can I say that is literally as complex as the answer needs to be. The so-called Magnificent Seven have just been going gangbusters in the US. They are the biggest 7 companies on the US market, almost all tech companies. There might be all tech companies, I think. They're just going through the roof. And Australian banks' profits have been ordinary to flat. Resources prices have been there or thereabouts. Those two sectors together, about 55, 60% of the Australian stock market. So where tech goes the US market. Where banks and resources go the Australian market. And at the moment, they're going in different directions. And it's just, frankly, that. One level below that, it's the results, but it's also sentiment. So investors are more excited about tech, and the results are pretty good. We've got some of these biggest tech companies in the world growing at 20% a year. It's phenomenal growth, amazing growth. I own Amazon, I own Alphabet. I think these are great businesses. They've got really bright futures. Again, I don't know what happens to the share price in the next 12 months, but long-term, really bright futures. They are inventing the future. They're gobbling up market share. They are the future, right? So I love it. But that's why. So you've got fast-growing businesses. The market is paying a lot more for. Back home, slow-growing businesses, the market's paying less for. Guess what that means? It means the market doesn't keep up. So that is the short answer. My best advice, not personal advice, but my best advice is to be invested in both. Why? Not because I'm trying to sit on the fence, but because who knows what happens with either of those two sectors. Currencies on top of that, by the way, but just in general. The problem with US investing right now is if you invest in a US index, I love index investing. For years, I've said the problem with the Australian index is it's all banks and miners. Now I've got to say, and the problem with the US index is all tech. So what do you do? Well, probably the best option is merge the lot. Have some exposure in the US, some Australia, some tech, some, I wouldn't have mining personally, but some other sectors that are in Australia. I think being sector and exchange agnostic is really, really important. Build your best portfolio, not worrying about what sector necessarily, but they'll be diversified. Not worry about what exchange or what country, but be mindful of currency fluctuations. That combination, that's why I have more than half my portfolio in the US. The rest is here. Not because I want to be in the US for the sake of it, because I like Berkshire Hathaway and I like Amazon and I like the other companies that I own. And I like the companies in Australia, like Domino's, that I've already mentioned, that I like and I own. If I don't like Domino's, I buy more Berkshire. If I don't like Berkshire, I buy more Domino's or anything else. So try and be agnostic if you can. I know your question was just simply why. I hope I've explained that's why. Fullness of time, we'll work it out. Maybe American investors who are excited about the US market, it comes down relative to Australia. Not necessarily down in total, just down relative to Australia. Maybe Australian banks' profits grow and our market comes back up. Those are the questions you got to answer. That's the answer, mate. Broadly, the macro geopolitical issues are universal or universal-ish, but the individual company valuations, the sectors that are dominant, have higher multiples, and that explains almost all of the difference between the two markets in more recent times.
All right, one final question to wrap it up. How do you think, I think I know the answer to this one, Scott, how do you think Berkshire Hathaway will perform moving forward?
Oh, man.
And how do we pronounce it, Berkshire or Berkshire?
Only ever Berkshire. Thank you, Adam. I will not listen to Poms who tells us Berkshire. If you're English, the Berkshire is the locality in England. That's wonderful. If you are American or otherwise talking about the American company, Berkshire Hathaway is a textile mill in New England. And that's now the name of the investment conglomerate run by Warren Buffett. It doesn't really matter. Who cares what you call it? Just don't spell Buffett with one T. That's buffet. Buffett's got two T's. I always joke with our team that they get a formal employment warning if they misspell Warren Buffett's surname, just for fun, alongside the ticker thing. I'm a very vindictive person, Adam. So Berkshire Hathaway. What I love about Berkshire is that, I love that Warren Buffett's there running the place, right? I think it's brilliant. Two contrasting issues. The first is Buffett has built, we talk about the equity portfolio a lot, how much Apple shares or what value of whatever other thing he's buying or selling. It's interesting and it's definitely worth a conversation. It definitely tells us something about what he's thinking and how he's investing. But Berkshire is far more the sum total of its wholly owned companies, whether it's insurance, whether it's manufacturing, whether it's retailing, whether it's service stations, whether it's used car lots, whether it's whatever. Berkshire's got a massive, massive, massive amount of wholly owned businesses. And that's where the value comes from. What I love about that is if Buffett's created a conglomerate of great business with good cash flow characteristics, they will persist long after Buffett. In other words, the value of the company is made up by the stuff that's owned already and is generating cash flows is a really large proportion of the total. Now, yes, Greg Abel, who replaces Buffett, is not Warren Buffett. He won't get the deals. He won't have the smarts. Not that he's not a very smart guy. He's not Buffett. Buffett is a once in a lifetime, once in a century, once in a whatever, investor person, whatever. So no one matches Buffett. And so future potential for Berkshire is less without Buffett than with Buffett. That's almost axiomatically true. The wholly owned businesses will keep that business in good shape for a really long time. The question of how they deploy the capital is an open question. I will make a fun prediction, Adam, just for the hell of it. I suspect within 5 years of Warren Buffett's passing, hopefully in like 85 years' time, they'll pay a dividend because they have got so much cash and nothing to do with it. They're so big now they can't put it to work. That's the other answer, the converse to what I just said, which is the bigger it gets, the more it must act like the US or the world economy because it just can't grow that much faster. Buffett said lots of times, if he had $1 million, he'd get 50% returns. He's not. He's managing, I don't know how much now, hundreds of billions of dollars. In that case, what returns can you get? Well, there's only so many opportunities out there now. What else do you buy? There's a dozen big companies you can buy outright, maybe, so the opportunity set is smaller. The returns must be lower in future. And he said that himself for a dozen years. Future will be worse than the past in terms of total returns. But I love Berkshire's conglomerate structure. I love its ability to redeploy its cash internally. I think it'll pay a dividend at some point in the near future. It's my largest single shareholding across both Australia and the US markets. I'm very, very happy owning it. I wish Buffett was around for another 25 years. It's not going to be the case, unfortunately. He's retiring this year. But I suspect it'll be a very, very good investment to own. Over time, I suspect it'll beat the US market by a bit each year on a compound basis for an extended period of time.
All right, now that was going to be the last question. However, we're going to have a bonus round
Hey!
now. But if you turned up to a Myer store 3 minutes before closing time and tried to gain entry, I doubt you'd have any success. But I'm going to allow it because it is Myer. It's down 30-something% over the last few days. So what are your thoughts on Myer, Scott?
I think it's a dead business walking. We talked about cost cuts before. What does Myer do? Sales growth of 0.5% like for like. Costs going up faster than that. Can they cut store staff anymore? I mean, you can hold a rave in Myer and not bump into a staff member. I think in its current form, it's in a world of hurt. Profit was down 30% for the reason I've just talked about. Why will it be any different next year? Who is going to shop there next year who wasn't shopping there this year? Probably no one. Their customer demographic is aging and frankly dying. And I don't mean that callously. They're not replacing their old customers with younger customers. They're just not doing it. This is a business with an existential problem in its current form. If I was in charge of Myer tomorrow, I would probably say no, thank you, or unless they offer me a really large amount of money, in which case I'd come to you, Adam, and say, can you match it? But they have a burning platform, a really significantly burning platform. If I was in charge of Myer tomorrow, I would close every single regional store and leave the probably 3 CBD stores, Brisbane, Sydney, Melbourne, open only, and their online platform. Ironically, and surprisingly to me, the online business is doing fantastically well while the stores are just falling apart. Why? Because the brand matters. People know the brand. And when they're jumping online, it turns out lots of people are happy to buy from Myer online because they know and trust the brand. That's a fantastic asset. You're just not going to go in your local regional Myer and go look for a pair of jeans or a shirt or a briefcase or a CD or whatever else people buy there these days. You're just not going to do it. People don't. They're literally just not doing it. So I think it's a burning platform. The businesses they bought from Premier, Just Jeans, JJ's, others, that's a much better business than the Myer stable itself. So Myer corporately, Myer's online business, some of that JJ's, Just Jeans business is okay. Solly did a great job getting Myer to take it because it's worth more to them than Premier. So yeah, I would not buy Myer. Doesn't mean the price can't double. It's been up and down all over the joint the last 5 years. Could double, could halve from here until they actually grasp the nettle and make some really serious structural changes to that business. I don't see how it can bring itself back from the brink unless it can somehow invent something that people all of a sudden love and want to go to Myer for. But I have no idea what that is. They've never been able to do it the last 20 years. This is a dying business in its current form, particularly those regional stores. Why would it keep the CBD stores? Footfall. You've got thousands of people who work within a kilometre of the stores. That's probably enough to keep those businesses alive and keep the brand out there and keep the name on the shop front. Otherwise, the online business is its future.
All right, a very straight answer. Thanks, Scott. That is all we have time for. So thanks for all your great questions. We love these conversations. Thank you, Scott, for working into the night, and we will see you all next time.
For long.